What's up traders, welcome to Failure to Displace, and in this video we're going to take a look at this morning's London session on EURUSD where we had a potential 6R in profit and we're going to try and master these macros. So the first trade was a 2022 model in the first macro of the London session, and then in the second macro we had a continuation model driving into the previous trade. We'll jump into the analysis now, see how these two presented themselves and what we can learn from this session. So as always, we're going to start off the day by checking out Forex Factory, see what news is on the table for us. We do have 2 AM, the pound red folder news retail sales, so we need to be aware of the open. And also 10 AM, we do have red folder news prelim consumer sentiment for the dollar in the New York AM session. Coming into London, we're going to be wary of this retail sales news drop. Before we jump into the daily analysis, please do me a massive favour and show some support by dropping this video a like. It would really mean a lot to me. With that said, let's jump onto the analysis now. So we're going to start the analysis off on the daily time frame. It's a bit tricky today trying to establish a daily bias because we're delivering from two inefficiencies. So I'm going into the day neutral, which is why I'm looking at the macros today. I didn't have a set bias for the 5-minute unicorn model that I've been trading. So because I'm neutral on the day, we're delivering from a bullish fair value gap at this point and a bearish fair value gap from this point. Very small candles. There's no decisive movement at this area. I'm just kind of winging it. So we're going to be trying to scalp the 1-minute time frame, just paper trading, because I have no desire to get involved in the market when I've got no idea whereabouts it's going to go. Here we are on the hourly chart. Let's mark out our points of interest on the hourly. We've got Asia high, there's a swing high, currently respecting this 1 hour fair value gap. Price has tapped that a couple of times. We've obviously got a bearish hourly fair value gap at this point here. Closed through a larger bullish fair value gap. So what I have noticed yesterday, something that I want to make reference to. Yesterday we were looking at an hourly breaker unicorn model based off this. So this is our breaker block with a fair value gap in between. So if you watch yesterday's video, we were looking at this as an hourly unicorn. When price came back in, we were looking for longs. I've realized today on this higher time frame, we actually had an opposing hourly unicorn here. So price had put in a high and then displaced through with a fair value gap, meaning that we had a bearish unicorn. Which ultimately played out better than the bullish unicorn. We did get a scalp in this area for a winning trade. However, price put in a low, put in a high, traded through that with displacement, leaving us with an hourly unicorn. And then price began displacing lower off that unicorn. So the short was definitely the way to go. I didn't realize that we had the hourly unicorn while I was in the session. So it's just always worth being aware of where we are on a slightly higher time frame. We had a bullish unicorn, but then that was superseded by a more recent bearish unicorn entry. Then we were leaving displacement. Larger candles in the London session were bearish. So this first engulfing candle really should have been an indication that we were looking for shorts. And if we had been looking for shorts, then that would have played out much nicer. So again, given that we've had bearish displacement from yesterday, potentially shorts are more favourable today than yesterday. But again, very indecisive consolidated price action. So we've got bearish fair value gap, we've got a bullish fair value gap that's holding us up. We do have large long wick put in overnight as potential bearish targets. As I say, what I'm doing is I'm paying very close attention to the macros today. So we'll drop onto the 5-minute time frame. We'll start skipping forward, looking for our first macro. You see, we trade through the fair value gap, then it is respected. and price begins retracing higher. So this is the open of our first macro, which does not seem to want to show on the 5-minute chart. On the 1 minute, we can see the macro opens up and we are taken directly into this 1 hour fair value gap that we highlighted. So we know that macros are going to drive for liquidity. We've put in a swing low. The open of the session, so the first hour. Obviously we had the pound news drop, which put in a swing low, potential manipulation. We've moved higher into an hourly fair value gap. Macro opens. So we'll take the high at this point. So here's our break of structure, potentially looking at the 2022 model. This is a swing low here. We've closed below that low, put in a new high, closed below the low. Closed through this fair value gap. So this is the key point that I would like to highlight. Is that we had a bullish fair value gap that's just been closed through with this bearish candle. So we're now seeing this may be an inversion fair value gap. Bullish PD arrays have been disrespected and we are in an area of resistance, so a point of interest where we would expect a reversal. We've had the 2022 model here, we're closing through. We leave a fair value gap. So if you wanted to trade this on the 2022 model, stop loss would be above the high. Target opposite side of the range, expecting the macro now to be spooling and driving for liquidity. We do have this order block here, which could potentially flip as a breaker. But that is the 2022 model. Into a point of interest, we're in a macro, so we're in a time where we're expecting price to do something. We get presented with the 2022 model. Leaving displacement. Price comes back, taps the fair value gap, so that would be the entry. Moves away. Closure through the order block. So now this order block, so this last up closed candle is an order block. We'll close through that one. Bear with me 1 second, sorry. This gets messy when you're on such low time frames. This is a breaker now. Tell you what, TradingView is tricky this morning. So this is flipped as a breaker block. That's that down closed candle there is now a breaker because we've traded through it. These up closed candles are order blocks. So we're stacking PD arrays here. Look, the quick things just don't want to work. Here we go. Right, so we've got an order block. You can leave displacement away from this order block. Good sign. You could potentially be looking for an entry lower down in the range if you didn't want to get involved at that point there. Now expecting that we are into a sell program, so any up closed candles and fair value gaps should act as resistance to propel price lower. So there's potentially a ladder in entry. Here, stop loss would be above this high. We could ladder that again. We're still targeting this low, 2.8R. Doesn't get tagged. That will be that entry. It's just outside the macro when this one gets tagged. Again, breaker block or mitigation block. So opposing sides of the buy program should act as resistance. So we do have a mitigation block there. We've got obviously a bearish fair value gaps coming down. Bit of consolidation. We want to see some acceleration down to take these lows. We're now into that inversion fair value gap, and then we do eventually sweep that low with significant displacement, bagging us a potential 3.5R or 2.84R. You could round that up to a nice 3R if you wanted. There was 2 potential entries at that point. An aggressive 2022 model entry, a more confirmed entry after we've had the breaker block here, leaving an order block again as additional confluence for our stop loss placement. So that is the first macro. We'll scroll through now, silver bullet hour. 403 is the open of the next macro. So we can see what's interesting again is that price has come and tapped the top of the New York PM session macro here and found support. So this is what I'm seeing very, very often. I would urge you to go back and just look at this. Macros, they tend to act like new week opening gaps or new day opening gaps as well. They're kind of magnets for price, and when price comes back, taps them, it can find support, it can run them as levels of liquidity. And at this point we did tap the New York PM session macro and then begin reversing. This is the open of our 403, 404 macro. So we're not looking to get into an entry until the open of the macro. What I do want to show you as the macro opens, this is 358, 359 on the 5-minute chart. We're developing again the 2022 model reversal. So we've swept some liquidity, we've found support on the top of the other macro, we've had a break of structure again on the inside here, and we've left the fair value gap and an order block at this point. We've obviously got this as a mitigation block or a breaker block. It's actually a mitigation block. Got a fair value gap inside, that's on the 5-minute time frame. We are looking at having a reversal on the cards, so we can drop onto the 1-minute time frame with that in mind. And here on the 1 minute, we can see we've got a couple of points of interest. So we've left ourselves a little order block here. Got a very small fair value gap above it. Slightly larger order block further down in the range. This shortcut thing is doing my head in today. With a more significant fair value gap in this area, we could look at where optimal trade entry is for this price run. Pull a fib from the low to the high. See, optimal trade entry is right into this order block fair value gap area. So this would be a key area if we do come back into this area at 403, potentially looking for longs around the optimal trade or order block area. So let's scroll forward. So we are getting a pullback, large displacement candle just before the 403 macro opens up into this lower order block. We are finding support there. So we had a sweep of liquidity, and then this is the first sign that maybe a buy program's coming in inside this macro. As the macro opens, we've got a large engulfing bullish candle here. And so that's the first indication. This is a bearish fair value gap. The next indication that I was monitoring was how price is going to react at this fair value gap. If we can flip this fair value gap into an inversion fair value gap, so it's acting as support, we can see then that bearish fair value gaps have been disrespected and potentially bullish fair value gaps will be respected. So again, leaving displacement through this with a bullish fair value gap would be another great sign. Currently we're respecting that fair value gap. We've left the bullish fair value gap here and we've closed through the bearish fair value gap. So this is now an inversion fair value gap. Inside we have this small bullish fair value gap. So this would be a very aggressive entry if you were convinced that you were going higher now. Having confirmation that we have had a break of structure on the 5-minute, We're coming into the macro, bullish engulfing candle. There would be a potential entry at this point off this fair value gap. Stop loss would be below this order block. You would expect these two down closed candles to act as support. So again, very tight stop losses in these macro trades. Ultimately, we are expecting the high of that macro to get traded through. I'm taking note of this fair value gap inside the hourly fair value gap. Price doesn't tag us in on this initial fair value gap. I moved my stop loss, I moved my entry then to the top of the order block, hoping that we would get tagged in at the top of the order block. What actually happens is that we leave a fair value gap, we get a tiny tap of the fair value gap into this inversion fair value gap. So we're just touching the top of the inversion fair value gap by a pip. I believe this is what they call the institutional order flow entry drill, where price will not dig into fair value gaps. It will literally tap them very quickly and then spool away aggressively. And this is what we see at this point. Leaving a small order block at that point. This small order block here was then my final point of interest for an entry. We left a fair value gap, so the order block generated a fair value gap. So I thought, again, institutional order flow entry drill, take an entry on the fair value gap, stop loss below the order block, expecting the order block to be our last line of defense, targeting the 50% of the fair value gap that was created inside our hourly fair value gap. You can see price does come back, taps this nicely, digs in a little bit deeper, respecting 50% of this fair value gap, then accelerates away really nicely. Now I'm going to be fully transparent. I did try to enter this on MetaTrader. So I paper traded this last one, and then I really tried to get in on this one because I'm feeling very, very super confident. My entry didn't get triggered because I didn't have the right margin, unfortunately. So because the stop loss was so tight, and I was trying to risk 1% on this trade, which is a little bit crazy, I suppose, in hindsight. I didn't have the margin to risk 1% on a 2-pip stop loss. So unfortunately, or fortunately, because maybe I was being a bit reckless, the actual trade didn't trigger. So I didn't get entered, but it does play out very, very nicely. Straight to the 3R take profit into this fair value gap. So if I was trading this lifetime, seeing this stalling around this fair value gap, I would definitely close out. End of the macro, very close to the swing high that we were initially targeting. Just close out, bag the profit, and then we can see the price does eventually begin reversing, which would have taken the stop if you hadn't have closed that out. Well, really significant entries there based on just monitoring the macros and higher time frames, so hourly points of interest, looking for entry patterns that we know work. You know, these are established entry patterns provided by ICT, and we are pairing these with the time element, and we know that the macros price does drive. And one of the things that I'm taking more notice of at the moment is the fact that I do believe that macros are draws on liquidity. So price will seek opposing macros. You know, when a macro opens, it will look for another macro. So if you can identify that as a draw on liquidity, there's some potential great trades there. So definitely something worth backtesting and trying for yourselves. I'm finding it very, very interesting. So I hope you found the analysis useful. If you did, please be sure to leave the video a like. I would really appreciate the support. If you've got any comments or feedback, leave them down below, and do consider subscribing if you're not already subscribed. I'm dropping videos like this more or less every day, and hopefully we can all kind of learn together and better our skills. So thanks for watching. I'll see you again in the next video.